A new report from the Wall Street Journal says Goldman Sachs and Morgan Stanley received a helping hand from the Fed on this year's stress test. Fed officials offered the banks the option of freezing their payouts at recent levels in order to keep from completely failing the test and continue paying its shareholders. The first deal of its kind since the start of the annual tests. So is this a sign the regulators are easing up on the banks? Bill, I guess there's two ways to sort of view this. One is, in fact, that regulators are going a little bit easier or taking some other kind of mitigating factors into consideration, or two, that Morgan Stanley and Goldman Sachs are running a little closer to the line than we thought.
Well, I always think about this from a household standpoint. How many people do you know have organized their finances around what it'll be like in the next depression? I mean, it's one thing to be a good steward of your financial resources, but these folks' stress tests are organized around the most horrendous unemployment and the most horrendous economic circumstances. So the fact they're easing off a little bit is like, okay, you've had your boot on their throat for 8 years, we'll back off a little bit.
My grandparents went through the Depression and they lived for the rest of their lives as if they were worried about the Depression. But Kerry, you know, I look at this news and I think back to the financial crisis. I say, you know, we predicted these guys were going to be regulated like utilities, and here we are. They're regulated like utilities. They kind of act like utilities. They're not very interesting anymore.
Well, it's amazing that we've had people predict across the sort of expertise front of cable news that the financials are going to be the big group of the year, and they certainly haven't been. They've been underperformers, and both Goldman and Morgan Stanley are each down over 10% for the year. And I think it's, to your point, in part about regulations, and they can't really make much money in a different kind of environment. But even if you were to remove some of those restrictions, it's a tough environment for them. No one is really looking for a lot of investment banking help. We have seen, very few IPOs this year, and their proprietary trading is sort of non-existent. But it's a tough market for them to make money in the old-fashioned way, even if they're able to do it, even if they were able to be heavily into the IPO and secondary market. There just isn't very much of it for them. So it's just an environment, the interest rates are not going up the way people had expected. And so I think that it's a disappointment in financial services across the board, and the big banks and big investment banks are suffering because of it.
Yeah, she's right, Maria. She's right that it got to be a crowded trade at the end of January. I don't agree about the profitability of these organizations. Bank of America is going to be in a position the next 5 years to return virtually 100% of the profit they make each year to their shareholders because of the overcapitalization of the bank. These banks, in many ways, they're overcapitalized. Now, in the scheme of a 10-year run, everybody goes through these corrections. The stocks were hotter than a pistol last year through January, so they correct for a year. And that just shows you the mentality of the stock market right now. Almost everybody invests on 3 to 6 month time frames, and the truth of it is, wealth is created over 10 years.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.